Alright, today is April 3rd, 2013. Let me start off this video by talking about Disney and then lead into the reason for me to close out the position in the after hour. Yesterday, during the trading hour, I was monitoring this setup and waiting for a trigger to trigger the setup to go initiate a long position on Disney. The level that I was watching for to move above is the 5720. So as it gain ground and start move to the this area here, and when it move about the 5720, it triggered my setup and I start looking for opportunity to initiate a long position, which I did. Then as throughout the trading session and near the close, as it closed up at this 5745. So it got a nice little profit, sitting there in the close. Then during the after hour and after looking at the some of the market, the stat after the close, I decided to close out the position and take it off the table. And not because of Disney is coming down in prices or anything negative on Disney. It's just that the some of the indication that I saw and how the market is closed, the market breadth indicator, it just I just lose that conviction to hold a long position under this particular environment. And let me go in and give you the some of the detail on why is that. And first of all, the target that I'm playing for initially on this trade is this new all-time high, which is somewhere around the 5782. Then once it break through this and make a new all-time high, and the ultimate target is somewhere up at this 127 Fibonacci extension, which will be somewhere around the $60 area. And this extension is essentially based on, let me see here, let me get this. It's based on this particular, you know, swing here, right? Between these, this move here, and going to swing this, and once it break through, and essentially this is a 127 extension on this particular movement. Okay, so that's basically what I was targeting this long position on Disney. And as you can see, if I put up the some of the stuff that I mentioned in the Monday post that I put in my blog, Last Chip Standing, the this, the story beneath the surface, where I talk about the divergence between some of the market indicators and the market indexes. And a couple of these indicators that I talk about, one is the advanced decline and the new high, new low. So if we take a look at this chart here, here's the S&P 500. That's making a new high. The advanced decline is actually showing a contraction. The number of advanced issue over the number of declining issue is getting smaller and smaller, so you get this negative divergence here. And also the new 52-week high, the number of stock that is making new 52-week high is also getting smaller and smaller as the market, this S&P 500 is moving higher. So you can see that kind of indicating some sort of negative divergence. And what I said on this post is that this negative divergence is usually is the first sign that the market kind of let us know that it is getting weaker. Then there's the as some of these market breadth indicator not only show a divergence but actually turn negative, then that would be a sign that the market is topping. And essentially that's what I saw today after the close. And if well, let's take a look at the chart here first. As you can see, here's the updated chart here. You can see that right here, right, you see this advanced decline actually is minus 103. That indicating that there is 103 stock or decline in issue. The decline over the advanced issue by 103. And also the new high, new low, it's not really moving up. And right now, this this the Dow Jones Industrial Average actually make it another new all-time high and close up 89 point. And while the S&P 500 also made a new all-time high and close up a little bit over 8 point at 1570.25. So if we take a look at this, some of the stats here. This is from the WallStreetJournal.com, and you could see that here's the advance issue in the New York Stock Exchange is the 1460, while the decline is 1563. So you can see there's a net difference of 103. There's more 103 more decline in issue than the advance. And then also the other thing is you look at the up down volume. You see the down volume is ahead of the up volume. The overall market here is the up down volume of 1.3 billion on the upside, 1.7 billion on the downside. So you can see that the up down volume in favor of the down volume, and the advanced decline is favoring the decliners. So with a market that is up 89 point or close to 90 point with that kind of ratio, that kind of indicating that the market is getting quite weak internally. So those sort of signs that it kind of raises the doubt of how much higher the market could go, as the internal strength is getting weaker. And that's the reason why I decided to close out my Disney position. It's not because Disney is not doing well. It's just that I don't want to take the risk to have this market get a abrupt turn to the downside, because the first of all, the market is already overextended, and with these negative breadth indicators, some of these negative breadth indicators, it just kind of indicate that the market could be at the top. If not, it's near the top. And when you get to that point in time for the market, the reversal could be quite abrupt, and definitely we could see some major gap down opening and that sort of thing. And so even though if Disney end up getting to that the 60 level, I would rather just risk that potential of missing that move than getting stuck holding the bag if it turn violently on a downside, and I get trapped with some unexpected losses. So that's basically the primary reason. So good luck to you on your